Now there's a couple of different ways that you can get your share of the profits. One way is you can get your share of the profits from appreciation. Appreciation means the valuation of the company goes up, which makes their stock price go up. So if you buy a share of a company for $100, this company produces bigger profits, it becomes a more attractive investment, and then the share price goes up to $200. Now you have $100 worth of appreciation that you get if you sell the company. But you only get that appreciation if you actually sell the company. If you have that $200 sitting in your stock brokerage account and you don't sell it, well, it's not actual money in your pocket, because then if that stock goes down to $50 a share, well, you just lost all of that appreciation and you lost that $50 that you invested because now you're down. But again, you don't actually lose money until you sell. So one way that you can make money and get your share of the profits is through appreciation. So if you invest your money in a good company, this company produces more products, produces more innovation, produces bigger profits, and it's an attractive investment, you can see your share price go up. And the second way that you can make money is through dividends. If a company has big profits at the end of the year, there are three things that they can do with this money. They can take this cash and reinvest it back into the company. They can take this cash and give it away to shareholders in the form of dividends, or they can take this cash and save it for an emergency. The second thing that you want to understand about dividend investing, number 2 and number 3, I'm going to be talking about the cons of dividend investing, is the cost to a company. Now, the easiest way for me to explain this is by giving you a personal example. Now, the example that I'm going to give you is of my own company, but understand we are not a public company, but this will help you understand the cost of dividends to a company. So let's assume that my company, Market Briefs, makes $1 million worth of revenue over the year. And over the year, we also have expenses. We have to pay our writers, we have to pay our business development people, we have to pay our salaries, we have to pay our softwares. Let's assume that our costs to run the company are around $400,000 a year. This leaves a profit of around $600,000 in the bank account. Now, if this were a public company, this would then be valued and it would have a market capitalization. And to keep things super simple, I'm going to put a market capitalization of 10 times revenue, which is $10 million revenue. So the company is worth $10 million. Then you can divide that up into however many shares you want. That gives you the share price. It's generating $1 million a year. There's $600,000 worth of profit. Now, with the $600,000 worth of profit, again, like I said earlier, there's three things that I can do with this money. I'm gonna put this in blue. I can save this money in the business bank account in case we hit a pandemic and something happens and now we need cash to help run the company. Or I can use this money to invest it into growth. We can hire more people, we can do more advertising, we can do more things with the company to grow bigger, to go faster. Or I can do essentially a dividend, where now, assuming I'm the whole owner of the company, which I am at the time of me recording, I own the whole company, I can take the $600,000, put this cash in my pocket, and then I can go out and buy a nicer car. I can go out and maybe invest in real estate. I can go out and buy some Gucci or Louis Vuitton. I don't do that, but I could if I wanted to. I can take this cash, put it in my personal bank account, and then I can do whatever I want. There is a cost and benefit to each one of these, not for me personally, but for the company. Because now, if I take the $600,000 of profit out, I put it in my personal bank account, well, then the company is not going to be able to grow as fast as it would have if I took the $600,000 and then I reinvested it back into the company. The third point that you have to understand about dividend investing has to do with the cost to you as an investor, which means, well, taxes. So let's go back to that example that I just gave you a minute ago. Company makes $1 million and then it has $400,000 worth of expenses, leaving it with $600,000 worth of profit. Now, this is the money that the company can pay out in the form of dividends, but the company can't pay out all $600,000 worth of profit, because when you have a profit, you got to pay taxes on that. The government wants their share of the money. So the first thing that's going to happen before they can pay out a penny in dividends now, assuming that they're going to pay out a dividend, is now you have to pay taxes. The company has to pay taxes on this money, and let's assume for the purposes of this video that the company is going to pay a tax rate of 20%. Now, this is where if it's a bigger corporation, they're going to have that lower corporate tax rate, somewhere between 21% and 28%, depending on which bills get approved and not approved. But that's kind of the general area of where this corporate taxes are. Now, just for your own understanding, companies don't always pay that full corporate tax amount because they're going to take deductions and other expenses and that they're going to take on their taxes. So they don't typically pay the full amount, but let's assume that they have to pay 20% of this profit in taxes for rough numbers, which means they're going to pay another $120,000 in taxes right here, which leaves $480,000 in profit. I'm doing all of these numbers right in the board in front of you, so if I make a mistake, I apologize. But $480,000 worth of profit, which they can then distribute to you as the shareholder. So I'm going to take this up here. So now I'm going to draw you with a nice mustache, and for our female followers, I'm going to draw you a nice braid. In my native language, Punjabi, we call a mustache a much, we call a braid a gut. So now this $480,000 worth of profit gets distributed to the shareholders, and now you get this cash in your pocket, and you're very happy, you're smiling, but now you got $480,000 in your pocket, and I'm assuming that all this cash is going to you. It's going to be distributed by each share, but it gets distributed, but then you have to pay taxes. You have to pay taxes on your individual tax return because you just got cash in your pocket. As soon as you get that dividend income, you have to pay taxes because that money hits your bank account. Even if you reinvest that dividend income back into the company, you have to pay taxes on your dividend profits. So now, you assume that you got $480,000 here. Now you are going to have to pay taxes on your dividend income again. Now you're going to say, but the money was just taxed. And you're right. This is why big corporations are known as doubled taxed entities, because you have to pay taxes on your profits, and then you have to pay taxes when the profits are distributed as well. So this $480,000 that gets distributed is already taxed income, but once it hits your personal bank account, when you are the owner of the company, then you have to pay taxes on this income again. The fourth thing, now that we're moving past the cons to understand how you can actually be a dividend investor smartly, is understanding, well, how do you be a smart dividend investor? And there's three things that you want to understand here. First is there's a lot of advantages when you can find dividend stocks at a lower price, because if you can find dividend companies, then you can, buy low, sell high, but if you can find them at a lower price, you can get benefits two ways. So let me give you an example. Let's assume that you can find a dividend company that's on sale and it's trading for $100 a share, and they pay out a $3 annual dividend. So they're paying a 3% annual dividend. And then the company price goes up because you were able to get it at a discount. So now this company is innovating, they're able to make more profits, and the share price goes up. And for the purposes of this video, let's assume that it doubles in price. So now it goes up to $200 a share. On one hand, your stock investment is a lot more valuable because your stock investment doubled. But then the company might also increase their dividends to make up for this higher share price as well, because now the dividend percentage has fallen to just 1.5%, because $3 of a $100 share price is a 3% dividend, and $3 to a $200 share price is a 1.5% dividend. So if a company's profits are growing incrementally and they're seeing bigger cash flows and they have this cash to give out bigger dividends, then what they might do is they might also double their dividend. So now you bought in here. You were getting $3 a share, but now your stock price has doubled. So if you look at your stock brokerage account, you're going to see a bigger number there. Your amount is doubled. If you invested $10,000, now it's $20,000. But now your cash flow also doubled because they're increasing the amount of dividends that you're getting. And you can see a bigger increase here, assuming that the profits go up. But this is where it gets even more interesting, because this is just assuming that the company isn't paying out a bigger share of their profits and dividends, because what a company could potentially do is say, well, we are so much bigger now, we have less room for investment in our companies, we actually want to increase our dividends to $7 a share. because now they have bigger cash flows and they don't have other places to put it. So if you're able to buy low, get into these companies earlier on, you can see bigger benefit in the dividend amount that you're getting. So now your cash flows are increasing every single year in addition to the actual value of your companies. So now you can win two ways. But in order for you to be successful here, you have to know how to research, because the mistake that so many people make, and it's a mistake that I made myself too, is you invest based off of this. You look at how much dividends a company is paying and you see how attractive the investment is. You might see a company that's trading for $100 a share that's paying out a $9 annual dividend. And you might say, holy moly, $9 a year, that's a 9% annual dividend. That's a great investment. And then you come in and buy. But what you might not see is that just a little while ago, the company was trading for $300. Sorry, you can't see it, $300 a share. So if the company has lost more than half of its market value, and the reason why it's losing is because it's on the verge of bankruptcy, and then you come in and buy because they haven't adjusted the dividend yet, you're just trying to catch a falling knife, but the knife is going straight down to the ground. And this brings me to number 5. How do you find good dividend paying companies? The first thing that you have to understand if you want to find good dividend paying companies is how do you find a company that's paying a dividend or not? And the easiest way to do that is by going to a stock research website. So you can go to Yahoo Finance, you can go to Seeking Alpha. There's a ton of them out there. Find whichever one you like. And so then when you go there and you research a company, you enter in the stock ticker symbol, they will show you if the company is paying out a dividend. Like for example, at the time we're recording, McDonald's is paying out a dividend, and you will see that they have a dividend yield there. That means that they're paying out a dividend. And right now Tesla is not paying a dividend. So if you search Tesla, you'll see that right now it's say NA. That means that they're not paying out a dividend right now. So that's the easiest way to see if a company is paying out a dividend or not. Now the question is, how do you actually decide if a company is paying out a good dividend and if it's a good dividend paying company or not? Now I'm going to oversimplify this because there's really an infinite amount of research that you can do here to see if a company is a good company or not. But the two things that I want to focus on for the purposes of the dividend are you want to look at the profits and you want to look at dividends. Now again, any of the stock research companies will be able to provide you this information, but the first thing that you want to look at are profits, and more specifically profit growth, because you want to invest in your company that is growing, that's not dying. And the way that you can see that in a dividend paying company is you want to be looking at profit, and more specifically profit growth. So you want to look at the last 3 years, look at the last 5 years, see what's been going on with their profits. Have their profits been growing consistently? And then the second thing that you want to look at are the actual dividends and the dividend growth. Now again, any of these stock market research websites will be able to provide you this information where you can just go look into the historical dividend data. Then you want to see what's been going on with their dividends. Have they been paying the same amount of dividends for the last number of years? Have they been cutting their dividends over the last number of years? Or have they been increasing their dividends for the last number of years? Now of course, past performance cannot predict or guarantee future performance, but what you want to see, especially in a stable dividend paying company, is you want to see dividend growth. Thank you for watching. If you enjoyed the shorter clip from the longer videos, here's another clip that I think you'll love. And if you're interested in learning more about how to invest your money in the stock market, our team put together an amazing guide that will walk you through how to invest your money in the stock market, what the stock market is, different stock market strategies, and how to build wealth in the stock market. This guide is completely free when you sign up for our daily newsletter. So if you want to read this guide, all you got to do is click that button right over there. Thank you for watching, and as always, keep hustling.